Good afternoon. Good afternoon. Jeremiah Conjure from Annuity Association tuning in for another exciting unbiased annuity review. It's been a couple weeks since we conducted one of these reviews, so I'm excited to get back in the saddle, excited to bring some value to those looking for insights on the various annuity products out there on the independent annuity marketplace. And really looking forward to just continuing the evolutionary process here as we continue with our mission to bring full transparency, more transparency to the annuity buying process. We're on a mission here at Annuity Association to really allow more information and content and feedback through these reviews to allow you and others as potential consumers to learn and educate yourself about the various product offerings on the marketplace today so that ultimately you can make an informed and educated decision. So really enjoying putting these stuff together for you out there, and the feedback that we've received from everybody, clients, prospective clients, even advisors and agents. The feedback that I've received within the last few weeks has just been incredibly humbling and motivating. And so, just going to continue on adding the value where we can. So without further ado, I'm going to go ahead and jump into our annuity disclaimer and then into the product review itself. So just bear with me. I'm going to go ahead and share my screen. Let me double check and make sure that I am not on mute. I have done that in the past where I've conducted an hour-long review and to only find out that nobody could hear me because my computer was muted. So I did say I would only make that mistake once. I've actually done it twice. So I'm trying at all costs to avoid that third time. And it looks like I'm not on mute. So great news. Okay, let me share my screen here, and then we'll dive into our handy-dandy disclaimer, get the legal stuff out of the way, and then get started. So without further ado, today we're going to be discussing the North American Prime Path Pro. This is a fixed indexed annuity with a 10 and 12-year contract term, and this is an independent, unbiased review by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. North American Company has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to individual circumstances. All names, marks, and materials used for this review are property of the respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. Okay, so we've gotten the fun stuff out of the way. I am going to now dive into the product brochure. So bear with me while I enlarge this to help make it as easily viewable as possible for those watching this review. So if you haven't done so already, you can enlarge your viewing window by clicking on the bottom right-hand corner of your viewing window currently, and that should allow you to expand the window to give you a larger viewing angle. So today we're talking about the Prime Path Pro. That is a tongue twister. I don't know if it was intentional or not, but North American put the Prime Path Pro. Try saying that fast 3 or 4 times. It gets really challenging. This is a 10-year fixed indexed annuity. They do also have a 12-year version, so we're going to be reviewing both. Really, the main details in those two will be the traditional rule of thumb. The longer you commit to in terms of the contract term, the higher growth opportunity or potential will be had because of the increased participation rates mainly, but could also have reduced caps if you go for a longer term, and increased caps and reduced spreads. So typically speaking, when you're looking at a fixed indexed annuity, the longer you commit to, the more growth potential there will be. So your Prime Path Pro to retirement. Planning for retirement can be overwhelming. Will I have enough to retire? How much is enough? How much longer will I need to work? And what happens if I have an extended illness? Will I be able to leave anything to my family? As you research options, you will be faced with various products in unfamiliar terms. Your licensed insurance professional and this brochure will provide information so you can determine that this product is a solution to help meet your needs during your retirement years. So before we go on any further in the brochure, first want to make sure that we're understanding what we're going to be reviewing in this unbiased annuity review. We're going to first start with going through the brochure so that we can understand the benefits and features of this individual product and to better understand how those can potentially serve you and your needs in retirement. And in addition, later on in the review, we're going to be taking a look at our hypothetical back-tested exercise where we'll take the current index crediting strategies offered in the PrimePath Pro and backtest them over the last 10-year period to see how they would have performed hypothetically if we owned this product during that time frame. So it'll give us the best 10-year performance, worst 10-year performance, and average annualized return over that last 10-year period so that we can make an educational decision on whether or not this is going to give us ample opportunity to potentially grow our principal investment. In addition to that, if you'd like to work with me directly, I work with clients in all 50 states. After this review, you can visit our website at annuityassociation.com. Right there on the main page, you can click your request to receive a free comparison report. In that opt-in form, you'll be asked if you would like to be contacted by an advisor. Simply answer yes, and I will reach out to you in a timely fashion to get together for a convenient time that works best for you. Okay, so if there's anything predictable about life, it's that it's unpredictable. But it's safe to say that when you retire, a few things happen. You want to protect and grow what you worked so hard to earn. You want to know that your retirement savings are not only protected from market downturns, but that there's opportunity for growth as you approach retirement. So one of the main reasons people are looking at fixed indexed annuities today is because of the guarantees contractually that are offered by the insurance companies that 100% of your principal investment is secure and protected and shielded from market losses. So every dollar that you put into an indexed annuity, you can rest assured that even if the markets have a downturn or a recession, that your principal investment is 100% protected from those losses. That also includes any interest that you've gained or earned over that period of time as well. So your gains are locked in and your principal is protected from market downturns. We also understand that you may need income. So to travel, to start that hobby you always dreamed about, to buy a vacation home, and to help pay for whatever it is that you want to do in your golden years. You may have unexpected costs. If you experience an extended illness, you may need access to additional funds. And you hope to leave something for your beneficiaries, a way to offer a legacy to your loved ones. The PrimePath Pro 10 fixed indexed annuity could help you and your family when any of these situations take place. We're going to read on to find out more on how it can do that. So first and foremost, the biggest thing people are yearning for in retirement is to retire with confidence. The PrimePath Pro 10 annuity is a flexible premium fixed indexed annuity that offers growth potential for your retirement assets while providing protection from downside market returns, as well as flexible options for taking lifetime income. None of us know the path that life has in store for us. That's why it's comforting to know that PrimePath Pro 10 has key features to help you on your journey. The first one being growth. So there's fixed and indexed account options that offer upside potential without downside market risk to the money you worked so hard to save throughout your career. The next is retirement income. PrimePath Pro 10 provides multiple options for taking retirement income, so you're in the driver's seat in determining how and when you start receiving payments. Liquidity options for if you need access to funds. PrimePath Pro 10 has different liquidity provisions that can help you when you need it most. There is an included death benefit. The PrimePath Pro 10 has death benefit provisions, so you may be able to leave something for your loved ones. And then, of course, one of our favorites is the tax deferral. So tax deferral improves your growth potential. Your annuity's value grows on a tax deferred basis, meaning more of it's working for you. Tax deferred growth means you don't owe taxes until you access funds, allowing more time for growth potential. Work with your tax advisor to find out how this might work for you. Under current law, annuities grow tax deferred. An annuity is not required for tax deferral in qualified plans. Annuities may be subject to taxation during the income or withdrawal phase. Please note that neither North American nor any financial professional acting on its behalf should be viewed as providing legal, tax, or investment advice. Consult with and rely on your own qualified advisor. This annuity may avoid probate by naming a beneficiary. You typically minimize the delays, expense, and publicity often associated with probate. Please consult with and rely on your own legal or tax advisor for probate processes. Annuitization payout options. By annuitizing your contract, electing an annuity payout option, or by turning on lifetime payment amounts, LPAs, you have access to a guaranteed income stream that will last as long as you live. The issue ages for the PrimePath Pro 10 is age 40 to 79 for both qualified and non-qualified dollars, and those issue ages may vary by state. And there is a minimum premium requirement. That's a flexible premium product, $20,000 minimum at issue. Qualified and non-qualified funds are available to fund this particular annuity. So to understand how this annuity works, it's important to first understand a few basics about two values in the PrimePath Pro 10 annuity. The first is the accumulation value. The accumulation value equals 100% of premium plus interest credited, less withdrawals and strategy fees, if any. Your accumulation value is the value used to determine penalty-free withdrawal amounts and your surrender value, which is the amount you would receive if you surrendered your contract early. Additionally, any remaining accumulation value may be paid to your beneficiaries upon your passing. And then the second basic is to understand what the benefit base is. The benefit base is used to determine your lifetime payment amount, or what North American refers to as the LPA. And this value is never available as a lump sum withdrawal. If you should pass away, the benefit base is available as a death benefit to your beneficiaries if paid out over 5 annual payments in lieu of the base contract death benefit. So the way that when I work with clients and they're fairly new to indexed annuities, I have everybody get out a piece of paper and a pen and then draw a large T for the T chart. And at the top portion of that T chart, on the left-hand side of the T, you're going to write accumulation value. And on the right-hand side, you're going to write income benefit base, or benefit base in this example. And it's very simple to understand that initially when you invest your monies or your premium into this product, let's say you use $100,000. Well, initially, when you put in $100,000 in that T chart, on line 1 underneath the T, 100,000 will go to the accumulation value and 100,000 will go to the benefit base. And what's neat about indexed annuities is that they have two different ways that these values grow. The accumulation value is all about the indexing and fixed strategies that are offered in the contract. So it's all based on the underlying crediting strategies, whether it be through indexing or the fixed account. That's what can influence that $100,000 and how it grows moving forward. So in any given year or 2-year period, depending on the strategy, if you have interest growth on those underlying index strategies, that will be credited to your accumulation value portion of your T chart and credit that 100,000 onward. On the right-hand side, the benefit base grows normally based on a contract, underlying contract value. So for example, when you buy an indexed annuity with a lifetime income rider, the contract for that rider is going to typically include what's called a guaranteed roll-up rate, which is essentially an interest rate that's applied to only the benefit base. Those roll-up rates today can be anywhere from 6 to 7% for the top performing guaranteed income annuities. And that guaranteed roll-up rate will be applied to that initial $100,000 premium investment and then grow compounded every single year that you defer the income stream, meaning every year that you don't turn the income on, that benefit-based value is going to grow compounded every single year by the designated roll-up rate in the contract. Now, this particular annuity, the Prime Path Pro 10, it does include a guaranteed value on the benefit base, but this particular product is more designed as what we refer to as an increasing income annuity that's based and designed on performance. So the income benefit actually is designed to grow based on how the underlying index strategies grow over time. And we'll be diving into the logistics or mechanics of that in more detail here very briefly, but just wanted to kind of educate you on the T-chart, accumulation value, benefit base, and how they each grow. The benefit base is only used to determine the guaranteed lifetime income amount when you turn it on. When you turn on the income stream, that benefit base value will be used to determine how much income you will receive. The other factor that goes into determining the income is what we call the payout rate or the distribution rate, which is based on your age at the time that you turn it on. And each product differs slightly, but there will be a payout rate. It could be 4%, it could be 4.5%, 4.6, 4.7. It depends on the product. It's best to get an illustration on the product you're interested in from your financial professional. And if you'd like to get an illustration on this product, you can go to our website, annuityassociation.com. Right there on the main page, click the green button to request your free report, and I will put together an illustration for you on that in a timely fashion. So, okay, so let's take a look at their breakdowns here. So on the accumulation value, you'll see basically what I've just narrated. It increases by the premiums and any interest credits, and it's decreased by any withdrawals, strategy fees for the associated index strategies, if applicable, and any lifetime payment amounts that are issued. And it's used for calculating penalty-free withdrawals, annuity payout options, death benefit, and surrender values. And then the benefit base is your premiums that go in. It's increased by the premium and then double the weighted average interest credit percentage during the benefit base roll-up period. I'll be breaking that down and educating you on what that exactly means here momentarily, so stay tuned. The benefit base can be decreased by any withdrawal at a proportional amount and any lifetime payment amounts at a proportional amount. So every dollar that comes out for lifetime income or withdrawals using the free withdrawal provision offered in this annuity, it will decrease the benefit base amount as well. And it's used for calculating lifetime payment amounts and rider death benefit paid out in 5 equal and an annual payment. So one of the biggest misconceptions in annuities is that if you buy an annuity and you pass away, the insurance company keeps your money. That is entirely false 99.9% of the time, unless you have one type of annuity that's structured in a particular way. It's called an immediate income annuity or a single premium immediate annuity that's structured for life only. What that means is when you buy one of those immediate income annuities and you structure it for life only, the stipulation is that if you do pass away, the income stream stops and there's no more money left for you or anyone else for that matter. In this particular annuity, and just about every single indexed annuity out there on the marketplace, if you pass away, there's actually a designated death benefit value that is aligned with the accumulation or contract value that will pass on to your beneficiaries 100%, and it oftentimes avoid probate. In this particular annuity, they give you the option to elect to receive the income benefit base value if you are okay with receiving it over a annual, on an annual basis over 5 years, or you can elect to take the accumulation value in a lump sum. Your beneficiaries will have that option to choose which one makes the most sense for them. Okay, so enhancing your retirement, one question people often ask themselves is, have I saved enough for retirement? And while enough varies by individual wants and needs, many consumers would like to have growth as they approach retirement. Fixed indexed annuities combine growth potential without experiencing loss of premium from market downturns or fluctuations. Interest credits in the PrimePath Pro 10 annuity will not mirror performance of the index itself, but rather the index closing prices are used as a basis for determining interest credits. PrimePath Pro 10 has unique and competitive options with the potential to grow your retirement dollars so they can work harder for you. Again, shortly here in this review, we'll be looking at the various indexing strategies that are offered in the PrimePath Pro 10 and really looking at them individually to determine which one would potentially give us the highest growth opportunity moving forward. So we'll be looking at an analysis that'll help us determine that. And did you know the PrimePath Pro 10 is a flexible premium annuity? That means you may be able to continue to put funds into the contract as long as you own it. So this is a great product if you're, approaching retirement, maybe within 10 or 15 years, and you're really looking to secure a portion of your nest egg from market volatility. And you're also looking to make ongoing contributions to it, maybe from your salary or business. This product will allow you to continue to make contributions, just like you make contributions to your 401k or other defined contribution plan. You can also do that with this annuity, which is a very nice added perk for those looking maybe at a 10 or 15 year window before they're expecting to need income from this product. And there are transfer options available. You may elect to transfer funds between the fixed account and indexed account options after the first contract year for the annual index account strategies, or every 2 years if you choose the 2-year point-to-point strategy. You may also elect to transfer between strategies annually or every 2 years for amounts allocated to the 2-year strategy. Based on current tax laws, these transfers between options will not be taxable or subject to current surrender penalties. So you can choose your index options individually, and that's where it comes in handy, really working with a professional that understands these annuities. Not all index crediting strategies are created equal, and it really comes down to understanding the available options to you, and then also knowing that you have the ability to have a level of diversification across the various indexing options that are available in your annuity, and really building a holistic diversification plan for the indexing strategies themselves oftentimes is very advantageous versus putting all of your eggs in one basket or in one index option. So there is a fixed account. We'll look at the guaranteed rate on that here momentarily. The fixed account offers a fixed interest rate that is guaranteed for the first contract year, and the rate for future contract years will be declared each year at the company's discretion thereafter and will never be less than the minimum guaranteed rate listed in your contract. And then for the index account options, while your premium is protected from market downside risk, PrimePath Pro 10 also provides the opportunity to take advantage of the market growth with its indexed interest crediting options. These index crediting methods allow you to select from different indexes. Each index account option may perform differently in various market scenarios. So there are annual point-to-point with participation rates, monthly point-to-point with caps, annual point-to-point with caps, et cetera, et cetera. I'm not going to read all these in detail, but there are quite a bit of various different crediting options and methods offered in this particular product, and it really comes down to understanding the different methodologies, and more importantly, working with a professional that can help you ascertain which one of those is going to be most suitable for your particular situation. Interest is credited on each contract anniversary for each index account option except the 2-year point-to-point options. For the 2-year point-to-point options, interest is credited at the end of each 2-year term. So real quick, let's break down what that means. So if you're in a 1-year point-to-point crediting strategy, essentially what that means, when you buy the indexed annuity, you're going to receive communication for your associated index crediting strategy and the particular underlying index itself. And what that's going to state is the issue date and the value of the index on that identified issue date. So for example, if you purchased the annuity on January 1st of 2021, your index value would be communicated to you for your underlying strategy and what that value was on that issue date. If you're in a 1-year point-to-point, that initial index value will be your starting point. Okay, remember, point-to-point. Your starting point is on your issue date. Fast forward a year, or on that 1-year anniversary, you're going to receive communication of what the ending value was of that same index strategy. And if the ending value was higher than the starting value, or the ending point was higher than the starting point, then you would have earned interest. You would have accrued some growth over that period of time, and that interest will be credited to your accumulation value and locked in moving forward. Same thing occurs in a 2-year point-to-point. You get the starting point and the ending point. It's just the only difference is instead of a 1 year, it's a 2-year period. And on that 2-year period, if the ending value of the index is higher than the starting value, then you've earned interest as well. You've had positive growth for that index, and you would be credited that interest to your accumulation value. So hope that makes sense. And okay, so let's look at the different strategies. So the index availability, they offer the traditional S&P 500. They also offer the S&P 500 low volatility daily risk control 5%, the S&P multi-asset risk control 5% excess return index, the S&P Maestro 5 index ER, the Morgan Stanley dynamic contribution, and that looks to be all of them. So there's quite a few different options in here. A lot of them are the S&P 500 branded indexes, both the traditional and what they call the low volatility or risk controlled index strategies. And then you have that Morgan Stanley dynamic contribution. Each of these indexes are going to be comprised with a slightly different methodology and growth potential that can be had based on the participation rates and things that are declared in the contract. So we'll be taking a look in our backtesting exercise to see which index stacks up at the top for best opportunity for growth moving forward based on that hypothetical backtested performance. So we've talked about the indexes themselves. We can give a little bit of an insight on what they are designed to do. So many of us know the S&P 500 is widely regarded as the best single gauge of the large cap U.S. equities market since the index was first published in 1957. The price return index includes 500 leading companies and leading industries of the U.S. economy and does not include dividends in the index valuation. The S&P Mark V, or what's also referred to as the Multi-Asset Risk Control 5% Excess Return Index, is a multi-asset excess return index that strives to create more stable index performance through diversification, an excess return methodology, and volatility management, i.e. risk control. The index applies rules to adjust allocations among multiple asset classes, creating a diversified basket of these assets. The index then adds an element of risk control by applying rules to allocate between this basket and cash. The index is managed to a 5% volatility level. So to just break that down, I am a big advocate for this particular index strategy because of the design and what its intended purpose is. The S&P Mark V and many other multi-asset risk-controlled indexes or low volatility controlled indexes are designed to provide more consistent returns over time, especially during very volatile periods. It is a dynamic, algorithmic-based learning index where it uses a balanced approach, again, a level of diversification across equities, fixed income, and commodities in this particular case. And the way that it works is that it has a 5% volatility control level. So in any one of those asset classes at any given time, if there's a 5% level that's exceeded for volatility in that associated asset class, the index methodology is designed to shift and rebalance real time by the day and shift those assets away from that volatility and move them into uncorrelated assets that can take advantage of that increased level of volatility in those uncorrelated asset classes. So what it does is it's designed to be able to move the monies in the index itself to other asset classes that can hedge volatility whenever it's triggered above that 5% level. So this isn't your home run, index strategy. It's not going to have huge swings or huge gains, but it is going to have consistent gains, which in my opinion are what we really should be looking at indexed annuities to do, and that is to provide a more consistent, decent, favorable rate of return, while also shielding our assets from big drops because of that contractual guarantee of principal protection. So I always say if we can really aim for 4 to 6% annualized rates of return, then we're doing really well. But there are annuities out there that can provide returns above that, significantly above that if markets perform. But it's more about consistency in the approach in terms of really using an indexed annuity the right way in a portfolio. So the S&P 500 low volatility daily risk control 5%, very similar as the one before. The only thing that differs is the weights of the different asset classes in that particular index. The S&P 500 low volatility index measures performance of the 100 least volatile stocks in the S&P 500, and the index adds an element of risk control by applying rules to allocate between stocks as represented by the S&P 500 low volatility index and cash. The index is managed to a 5% level. So rather than adding in fixed income and commodities into this strategy, they're more focused on the 100 least volatile stocks in the S&P 500 and rebalancing across those in combination with a weight in cash to manage volatility. We have the S&P Maestro 5 Index Excess Return. That's another multi-asset index that strives to create more stable index performance through diversification and excess return methodology and by managing volatility. The index covers major asset classes, which represent equities, U.S. Treasuries, gold, and cash. Equity is represented by 4-factor indices: quality, momentum, low volatility, and high dividend, while the U.S. Treasuries use both 5 and 10-year maturities. The index applies established rules to allocate amongst those asset classes and also includes an equity hedge overlay using midterm and short-term VIX futures, which may increase performance in times of higher volatility. The index is managed to a 5% volatility target. And then the Morgan Stanley Dynamic Contribution Index is a rules-based strategy that uses modern portfolio theory principles and the related concept of efficient frontier to attempt to maximize returns for a given level of risk. The MSDC index provides access to global opportunities by investing in multiple asset classes representing global equities, government bonds, and major commodities. The MSDC index seeks to dynamically allocate to a portfolio nearest to the efficient frontier on a daily basis, and the MSDC index computes recent returns, realized volatilities, and correlations for each asset over 2 time horizons, short-term and long-term. All combinations are then screened to identify the highest historical return portfolio for 5% target risk level, subject to allocation constraints for each asset class and individual asset. Okay, so there's quite a few different options there to allocate your money, and you have the ability to diversify amongst all of those various index strategies. You can choose to put 25% in one, 25% in another, and 25% in another, and 25% in another if you so wish. It's really going to come down to working with a financial professional that understands those index strategies and your individual needs, and that can guide you in how to allocate within that annuity. So your annuity can grow through the accumulation value that's earned from the various index interest crediting methods, and your benefit base grows based on the provisions of the benefit rider, which is included for no additional charge. So there is no rider fee for this particular lifetime income rider that's included in the Prime Path Pro. And we are going to talk about the benefit base roll-up, and that is during the benefit base roll-up period, the benefit base grows each year by the benefit base roll-up amount. The benefit base roll-up amount is double the weighted average interest credit percentage which reflects credit rates and strategy fees if applicable, and times the benefit base. What this means is if the weighted average interest credited across all strategies is 3%, the benefit base is $100,000. The benefit base roll-up amount will be $100,000 times 2 times 3%, or $6,000. The benefit base after the benefit base roll-up amount will be $106,000. The benefit base roll-up amount will be floored at 0. So what they're basically saying in that long explanation is that this is what we call a performance-driven benefit base rider. Performance-driven based on the underlying index strategies, and the rider itself includes what we call a multiplier. So for example, let's say you put in $100,000 into this Prime Path Pro 10. Your benefit base will start with $100,000, and then let's say you're in a 1-year point-to-point crediting strategy on your accumulation value and index strategies themselves. So after that 1 year, let's say the growth is 10%, just throwing out a number for easy math. Because the benefit base rider includes that multiplier, and in this case, the multiplier is 200%. If you had 10% growth on your indexes, or your index strategies rather, then you would get 20% credited to your income benefit base value. So on the accumulation value, you would have 10% credited, so the 100,000 would turn into 110,000. And then your benefit base, because of the multiplier provided in the rider, included in that rider, you would actually get 20% credited to your benefit base, which is used for your lifetime income calculations. So your 100,000 would actually grow to 120,000. So in theory, if these index strategies perform, the multiplier of 200% gives you a lot of growth potential for lifetime income during a period, 10 or 15 year period of time that you're deferring income. So this can be a great product if you're really looking to maximize guaranteed income, and you really have a lot of confidence that the index strategies can outperform or can perform well rather, because you have a 200% multiplier. So even if the index strategies perform modestly, 3 to 5%, while you're getting at least 6 to 10% because of the 200% multiplier credited to your income benefit over time, every anniversary. So it can be a very beneficial product, if the index strategies perform because of that 200% multiplier included in the benefit-based income rider. So the benefit-based roll-up period is each contract anniversary until the earlier of the 15th contract anniversary or the lifetime payment election date. So this roll-up period included in the income benefit rider has a max of 15 years, is what that's saying. So it means that every year you can defer it. You can defer to receive your lifetime income payments up to 15 years. So you have 15, if you were, let's say you're 45 and you want to turn income on at 60. Well, you're going to have 15 years that you can let this index strategy and the associated index strategies grow for you, multiply by the 200% rider multiplier, and credit your income base to really build it up large over time. 15 years is a long time, so it gives you a lot of opportunity. The benefit-based floor is equal to the premiums, less any proportional reductions for withdrawals accumulated at the benefit-based floor annual roll-up rate. When you utilize the benefit base by starting lifetime payment amounts, the benefit base is guaranteed to be no less than the benefit base floor. The benefit base floor roll-up period is each contract anniversary until the lifetime payment election date. The death benefit maximum is the rider death benefit, the greater of the benefit base and the benefit base floor as of the date of death, subject to a death benefit maximum. The rider death benefit maximum for some states is the greater of 250% multiplied by the total premium less gross partial surrenders, or 125% multiplied by the cash surrender value. So what they're saying here is the death benefit, they're going to have a max depending on the state, but it can be the greater of 250% multiplied by the total premium investment, less any partial surrenders, or 125% multiplied by the cash surrender value. So that will differ by state. So here we're going to look at a benefit-based roll-up example. This is a hypothetical example of a couple approaching retirement, and it will explain how all of these values work together. So Nick and Vicky have worked hard to save for retirement. Nick chose a Prime Path Pro annuity because he liked the idea of growth potential of a fixed indexed annuity while not being subject to market losses. He put $100,000 into his Prime Path Pro annuity and let it accumulate for 10 years without taking any withdrawals or starting lifetime payments. The chart below shows the benefit base floor, which increases at 1% annually. The chart also shows how the benefit base increases each year, assuming that the weighted average interest credited with strategy fees reflected, if applicable, was 3% each contract year. The benefit base is increased by the benefit base roll-up amount during the benefit base roll-up period. The benefit base roll-up amount is double the weighted average, or 200%, interest credit percentage. So 2 times 3% equals 6% in this example, times the benefit base. The benefit base roll-up amount will never be less than 0. So here's the hypothetical example, $100,000 going in. The guarantee in the benefit base floor is that it will increase by at least 1% annually, guaranteed by the contract. And the benefit base is increased by the benefit base roll-up amount during the benefit base roll-up period. So during that 15 years, the benefit base roll-up can double the weighted average interest credited interest. So in this case, they're showing that the index crediting strategy performed at 3%. Times 2, or 200%, would be 6%. In this example, times the benefit base amount. And then for strategy fees, the weighted average interest credited percentage reflects interest credit rates and strategy charges. The 3% used in this example would be reflective of a credit rate of 3% on allocations to annual crediting methods without a strategy charge, or a 3.95% credited rate on allocations to annual crediting method with a 95 basis point strategy charge. So across the different index crediting strategies in the Prime Path Pro 10 and Prime Path Pro 12, there are strategies that have what we call a strategy charge, which is basically a fee of 95 basis points that is essentially buying you a higher participation rate on that underlying index itself so that you can have higher growth potential. But there are also non-strategy charged index strategies, so there's no fees also available. So essentially, you could have a Prime Path Pro 10 or Prime Path Pro 12 annuity with no fees. Okay, so one of the biggest misconceptions of annuities is that they're highly feed. 99% of the time, that is associated with one type of the 5 types of annuities. It's called a variable annuity. This particular annuity is an indexed annuity. It's not a variable annuity. And most fixed indexed annuities can oftentimes be zero feed products. The only time there's a fee associated is if there's a rider elected to add to the contract, whether it be for lifetime income or enhanced participation. And usually that fee is anywhere from 1 to 1.75%, depending on the product. But it's completely optional. It does not have to be elected. It can be a zero feed product in this case for the Prime Path Pro 10 and Prime Path Pro 12. What you would want to do is work with a professional that can show you an analysis on the strategies with the performance enhancement rider and without the performance enhancement rider to determine whether or not the rider is worth it. Most oftentimes in my research, depending on the product, but most oftentimes the performance enhancement rider does add more value by giving you higher growth potential. And we do that through the back-tested performance exercise to determine if that strategy charge would pay for itself essentially because of the increased performance on that index. So in this example, you see the 100,000 starting out on the benefit base, and then you'll see the benefit base roll-up amount being applied in that second column, the lighter gray. And you'll notice the credits that are being applied for every year when there's index performance. In years that there are no index performance, the benefit base roll-up amount does grow at the 1% rate. So that's what you're seeing occur there. So after 10 years, the benefit base amount, okay, look at the end of year benefit base, you'll notice based on this example, after 10 years, the income benefit base has grown from $100,000 to $179,085. Again, you do still have a benefit base floor, which is growing at 1% guaranteed in the contract. But really, this is an annuity designed for performance based on the index strategies available. It does have that 200% multiplier. So every time the index crediting strategy grows or earns interest, you'll multiply that interest by 200%. And that's the credit being given to the income benefit base for future income needs. So for retirement income, outliving income in retirement has become a concern for many retiring consumers. The Prime Path Pro 10 can provide confidence that it will be there to provide income you can't outlive and to provide for the possibility of increasing payments over time. Lifetime payment amounts, after your 50th birthday, the Prime Path Pro 10, man, that's really starting to twist my tongue up there. Fixed indexed annuity provides you two choices for taking lifetime payments. The first choice is the level lifetime payment option, which provides a level payment amount for either the rest of your life or joint lifetime if you choose for you and your spouse. Any excess withdrawals that you may choose to take from your Prime Path Pro 10 annuities accumulation value will reduce your future lifetime payments by a proportional amount. Increasing lifetime payments is the second option. This option starts at a lower initial payment amount than the level payment option, but has the possibility of increasing each year based on the weighted average interest credit percentage. So for the level lifetime payment percentages, you'll notice here the attained age of a covered person, it starts at age 50. And then you'll notice the actual payout amounts for a single covered person or joint covered persons. So you'll see 3% and 2.5% respectively. And then every 5 years, those payout percentages actually increase by 50 basis points. So you'll see age 55, it goes to 3.5%. And then for joint, it's at 3%. And then age 60, it goes up to 4 and 3.5 respectively. And then you'll notice for the increasing lifetime payment percentages, they start, somewhat lower, 60 basis points lower roughly. And they still have that 50 basis point increase every 5 years, whether it be single life or joint life. So what that's really doing, so this is the other calculation used in determining the lifetime payout amount. The first calculation is the actual benefit base amount. And then you multiply that income benefit base amount by the payout percentage, which is shown on this chart here. And then that would equal your lifetime payment amount on an annual basis. So very simple. When you do choose to elect to turn on lifetime income, you're most oftentimes going to be locking in that payout percentage at that stated age when you decide to turn on the lifetime income. So that will stay fixed once you turn it on. So here they show a lifetime payment amount example. You'll notice here that the initial age is, they're showing age 75 and age 80. The person purchased the contract here at age 70, and the benefit base has grown to $179,085. And they're at the 5% level payout and the 4.4% increasing payout percentage, depending on the option they choose. The lifetime payment amount increase percentage is 3%, which is 100% of the hypothetical assumed weighted average interest credit percentage. So on this chart, you're going to notice the light green and dark green lines on the axis. And on the axis, you're going to notice the light green shade is the level payment option. So you're going to notice that it's growing during the years of deferral. And then when they elect to turn on lifetime payments in contract year 11, you're going to notice that the lifetime payment option is level from there on. That line just flatlines all the way through the rest of the retirement planning horizon. The solid or dark green rather line, you'll notice grows up to contract year 11. And then when the lifetime payment amount is elected, they still have an increasing option because of the nature of the increasing lifetime payment amount. Most oftentimes when someone purchases this type of annuity, they're buying it for that potential of increasing income throughout the rest of their retirement. So there are a handful of different annuities that compete with the PrimePath Pro 10 and PrimePath Pro 12 that are structured in the same exact manner. Really going to come down to comparing the 2 or 3 different options available to determine which one's going to be best for you. And if you'd like to do that and work with me directly in helping you formulate that comparison, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report. On that pop-up opt-in form that's broadcast to you, it will ask if you'd like to be contacted by an advisor. Simply answer yes, and I will reach out to you in a timely fashion to get together and help point you in the right direction. So, okay, in this PrimePath Pro 10 and 12, you do have penalty-free withdrawals that are allowed in the contract. So during the income deferral period, you still have some liquidity in regards to accessing your principal and any interest that's accrued over time. In this particular case, you can access up to 7% of the accumulation value as of the beginning of the contract year. And it can be taken each year without incurring any surrender charges whatsoever. After the surrender charge period, surrender charges and any associated market value adjustments are no longer applicable to any withdrawals. This product does also include the nursing home confinement waiver. It may not be available in all states. After your first contract year, if you become confined to a qualified nursing care facility for 90 consecutive days, you can withdraw 100% of your accumulation value without a surrender charge and without an application of a market value adjustment. You cannot be confined at the time your contract is issued. This rider is automatically included with your annuity at no additional charge. If joint annuitants are named on the annuity, the waiver will apply to the first annuitant who qualifies for the benefit. So this is one of the answers to I guess one of the roadblocks or objections that were received by prospective clients looking at annuities, and that was, well, what happens if I have a nursing home care need or need long-term care assistance and I have this money in this annuity? I may need access to it. I may need liquidity to help me pay for nursing home care or any other cost of care if you're confined. And if that's the case, rest assured that in most annuities today, they include this type of provision to allow you more peace of mind, knowing that if something like that occurs, that you can utilize the associated funds in this annuity to pay for the cost of care. So it's a very good perk, very good peace of mind. Please make a note that that is available to you. Okay, they do offer annuitization as an alternative to the lifetime payment amount. PrimePath Pro 10 annuity offers annuity payout options. Discuss with your financial professional the differences between annuitization and taking lifetime payment amounts. So annuitization is the older way of converting an annuity to lifetime payments. But it's very rarely done these days. Maybe less than 3% of annuities purchased today elect to annuitize. And the reason for that is because most annuities now offer lifetime income riders, which allow you to earn interest that's guaranteed in the rider contract, while also still giving you control over the asset and the accumulation value itself. If you choose to annuitize, you're essentially, and not have the lifetime income rider, you're essentially giving up control over that accumulation value in exchange for a guarantee of lifetime payments. So it's a very old way of doing lifetime income. Some people do still do it, but very rarely is that option elected. Your annuitization payout options will differ depending on the state, but you will have income for a specified period, income for a specified amount, life income with period certain, life income, joint and survivor life income. And the income options for those period certains are available from 5 to 20 years. And if you're located in Florida, those options differ slightly. You can elect to have life income with 10-year or 20-year period certain, joint and survivor life income, joint and survivor life income with 10-year or 20-year period certain. So if you have a period certain, all that's saying is that it's going to guarantee a lifetime income if you elect life income with a period certain. And in the event that you do pass away early on in receiving that income stream, it's going to guarantee that it'll at least pay out to your beneficiaries for 10 years or 20 years, depending on which option you choose. The lesser of the two will provide a higher guaranteed income amount. If you choose a longer period certain, it's the amount that they pay is going to be slightly lower than the 10-year option. Okay, so market value adjustments. Your contract also includes a market value adjustment feature, which may decrease or increase your surrender value depending on the change in the index value of the market value adjustment external index since your annuity purchase. Due to the mechanics of a market value adjustment, surrender values generally decrease as the market value adjustment external index rises or remains constant. When the market value adjustment external index decreases enough over time, the surrender value generally increases. However, the market value adjustment is limited to the surrender charge or the interest credited to the accumulation value in all states except California. In California, the market value adjustment is limited to the surrender charge or 50 basis points of the accumulation value at the time of surrender. This adjustment is applied only during the market value adjustment period to surrenders exceeding the applicable penalty-free allowance. So a market value adjustment is just a protection clause for the insurance company that in the event you don't hold up your end of the bargain and keeping your money in the contract for that 10-year or 12-year period, depending on the product term you choose, that they have the right to charge what's called a market value adjustment if the interest rates are higher than when you initially bought the annuity. If interest rates are lower, then it could actually favor you, and where they'll actually pay you more money to adjust for that increase in or decrease in interest rates. So it works just like bonds. When you buy a bond, let's say you bought a bond today, which is, let's say it's 1% interest, and you're supposed to keep that bond for 10 years to maturity, and interest rates actually increase to, let's say, 3%. Well, the value of your bond has just reduced because your bond is only paying a coupon of 1% for that 10-year period. So it's actually worth less than if someone were to buy a current bond with a coupon of 3%. So you would actually lose in that deal. But it works adversely. If you owned a bond that had a 3% coupon and interest rates lowered to 1%, well, your bond is very valuable to someone looking to buy bonds because they can only go out and buy a 1% bond and yours is paying 3%. So you would actually earn more money for that bond if you chose to sell it at that time. So market value adjustments work the same exact way. These insurance companies are buying fixed income debt instruments and things of that nature that highly involve interest rates and movements of interest rates. So to ensure that they're not setting themselves up for a bad day, they allow these market value adjustment clauses and provisions in the contract to hold everybody true to the economic environment and the contract term. So hope that makes sense. During the surrender charge period, a surrender charge is assessed on any amount withdrawn as a partial or full surrender that exceeds the penalty-free amount and may result in a loss of premium. Additional premiums deposited into existing contracts will maintain the surrender charge schedule set forth at policy issue date. Certain annuity payout options may incur a surrender charge. So you do have that free withdrawal provision of 7% per year. Anything above that 7% will be charged that surrender charge fee, which in this case it's 10% the first 5 years, and then reduces by 1% each year up to year 10, ending at 4%. The surrender charge schedule can vary slightly by state, so be sure to work with your financial professional to understand your current surrender charge offering in your given state. Again, we work with all 50 states using Zoom. So if you'd like to work with me directly, you can visit our website, request your free report, and answer yes if you'd like to be contacted. And I will be more than happy to have that opportunity to help point you in the right direction. So what if? Let's talk about the lifetime payment amount multiplier. That is the whole idea and design of this particular product. Is if you have a health event after your second contract year, that leaves you unable to perform at least 2 of the 6 activities of daily living, also referred to as ADLs, as defined in your contract. So not only do you have a multiplier on your increasing income option based on index performance, but you also have another multiplier that's included at no additional charge for long-term care events. And those are determined by being unable to perform at least 2 of the 6 activities of daily living. Those things are like walking, feeding yourself, continence, dressing, bathing, toileting. So if you're unable to perform 2 out of those 6, your lifetime payment amount can double for up to 5 years of payments as long as you continue to meet the requirements on each annual payment date. This feature is no longer available when the accumulation value reaches 0. Increased payments will not begin until 90 days after the lifetime payment election date. Regardless if you choose the level or increasing lifetime payment amount option, your lifetime payment amount multiplier benefit is always double the lifetime payment amount for the current year. So here's a hypothetical example of how this could work for you. At age 70, Nick decides to turn on his level LPAs, which in our example is $8,954 annually. If eligibility requirements are met, the lifetime payment amount multiplier can then double the level lifetime payment amount to $17,908 annually for up to 5 years of payments. So you'll see the $8,954 being doubled by $17,908, and that can be paid up to 5 years if each year that you still qualify for that benefit. So that's a lot of value and just an extra perk that's included at no additional cost in the PrimePath Pro 10 and PrimePath Pro 12 fixed indexed annuity offered by North American Company. So what if the spousal continuance before or after starting lifetime payment amounts? If your spouse is your sole beneficiary, then your spouse can continue the annuity until he or she is ready to start taking lifetime payment amounts. If joint income is elected on your PrimePath Pro 10 annuity, your spouse can continue taking lifetime payment amounts for the rest of his or her life. Lifetime payment amounts cannot continue if single life withdrawals are taken. So that's good to note that if you structure it for joint, the payments will continue to your surviving spouse for the rest of her or his life. So that gives you extra peace of mind knowing if something happens to you, your spouse will be taken care of. And the death benefit, even if you purchased your annuity for lifetime payments, the PrimePath Pro 10 and 12 annuities, death benefit provides the opportunity to leave your annuity's value to loved ones. If you should pass away, your beneficiaries have the option to receive your benefit base paid out in 5 equal annual payments. Or alternatively, your beneficiaries also have the option to receive any remaining accumulation value as a lump sum. So here's a hypothetical death benefit example, $100,000 initial premium going in, no additional premium and no withdrawals have been taken, and there's been a 10-year accumulation period prior to death. The weighted average interest credited percentage is an assumed and hypothetical rate of 3%. And you'll notice that at the time of death, the accumulation value has grown to $134,392, and the benefit base for income has grown to $179,085. So the beneficiaries in this example would be able to elect to have the option 1, which would be the value of the accumulation value lump sum, or they could elect to take the benefit base, which is a larger amount. The only stipulation is that they would get 5 equal annual payments instead of 1 large lump sum. So there is some value in deferring that income or distribution rather over 5 years because you're getting more money in the end. Okay, great. So we're at the end of our review for our product brochure review. For those not familiar with North American Company, they are an A+ rated carrier through AM Best, S&P Global Ratings, and Fitch Ratings, which is a superior rating through AM Best. North American has continued to earn high ratings based on their financial strength, operating performance, and ability to meet obligations to their policyholders and contract holders. North American continuously holds an A+ rating on the financial rating scale from AM Best. They are located in West Des Moines, Iowa. Okay, so if you're still with us, right now we're going to go ahead and look at our hypothetical back-tested performance exercise. What this is specifically going to do is take a look at the various index crediting strategies offered in the PrimePath Pro 12 and PrimePath Pro 10 to determine over the last 10 years how that associated crediting strategy would have performed hypothetically if we owned this product during that time frame. So you'll see here on your screen, we have the 10-year column here to the right, and then you'll notice the performance numbers alongside the product and the crediting strategy listed there below it. So here coming in number 1 over the last 10 years is the PrimePath Pro 12 using the 2-year point-to-point S&P Mark V with participation rate. The current participation rate at the time of this review is 125%, and that is an enhanced strategy where there is an associated rider charge for that enhanced strategy, and that is 95 basis points, so just under 1%. And this annualized return number, the 6.12%, is the annualized credited performance or the annualized interest over that 10-year period. And you'll notice 2 numbers below that 6.12, and that is the green number, which is 6.75%. What our software is doing is taking a look back over that same 10-year period and determining what the highest 10-year performance would have been. And in this case, it would have been from December 30th of 2009 to December 30th of 2019. The performance would have been at 6.75%. And then on the other side, the red number, which is still a positive number, it's just indicating the worst 10-year performance over that last 10-year period. That would have been from December 30th of 2010 to December 30th of 2020, and it would have performed at 6.12. Moving on to the second product on the list is the PrimePath Pro 10, using the same 2-year point-to-point S&P Mark V index with participation rate. And it does have that enhanced strategy charge of 95 basis points. This participation rate is the only difference between the 10 and the 12. The participation rate here is 110%. So with that slight decrease in the by 15% on the participation rate, you'll notice that during that same 10-year time frame, this product would have performed on average of an annualized rate of return of 5.43%, best 10-year performance at 5.98, and lowest 10-year performance at 5.43. In addition, the PrimePath Pro 12 with the 1-year S&P Mark V enhanced participation rate strategy with the 95 basis point charge. The 1-year point-to-point comes in third on the list with an 85% participation rate and a back-tested performance of 5.08% average annualized credited interest over the last 10 years, and then a 5.51% best 10-year period and 5.08% worst 10-year period over the last 10 years. And followed up by the PrimePath Pro 10, their 1-year point-to-point coming in at a 75% participation with that enhanced strategy charge of 95 basis points. We see an average annualized return of 4.49%. Okay, so that covers the indexes and the back-tested performance exercise to determine which strategies are going to perform potentially the highest moving forward based on looking back over the last 10 years. We'll see that the S&P Mark V comes in at the top, but we'll also see that Morgan Stanley Dynamic comes in also at a 4% rate of return over the last 10 years. And the S&P 500 low volatility on the PrimePath Pro 12 comes in just under 3%. And on the 10-year version, it comes in at 2.5. So if you're looking at the Prime Path Pro 10 or 12, you're more than likely going to find more value in the S&P 500 Mark V index versus any of the other associated index strategies offered within the annuity. Again, we do often advocate for a diversification of spreading out your monies through the various index strategies. The main reason being is that you have 3 or 4 different indexes working for you versus one. You're going to reduce the chances of ever having a zero credit in any given crediting period because you have 4 different indexes going, at the same time. The ultimate goal of an annuity is to get consistent returns and avoid losses. You can avoid the losses because of the contractual guarantee of principal protection. But if you have a zero, you have a zero. If we can reduce the chances of having a zero in any given crediting period, you're increasing the option for a higher average growth rate over a long period of time. Okay, let's look at one more exercise here. We're going to look at the advanced calculator, where we're going to take a deeper look at the actual increasing income option found in this particular annuity. Again, the main reason that people look at the Prime Path Pro 10 or Prime Path Pro 12 is because it is one of the few indexed annuities that offers the opportunity for lifetime increasing income based on the performance of the underlying indexes. So I'm going to go ahead and throw in some hypothetical data here. We're going to look at an example using a 60-year-old male with a $100,000 single premium investment located in the state of Florida. And we're going to sort it for the Prime Path Pro 10 and 12 and take a look at the hypothetical. So what this calculator is doing is we're going to elect when we're going to turn on the income, and it's going to automatically plan for an overall 30-year planning horizon. So we're looking at the scale from age 60 to age 89 or 90, and then we're electing that we're going to start income at age 70. So let's go into the increasing income option, and here we are going to see the Prime Path Pro 10 come up as the number 1 option. So what we're doing here is the software that we use here at Annuity Association is designed to help us make educated decisions on which annuities are going to give us the highest growth potential, both from an accumulation perspective as well as an income perspective, whether it be fixed income or lifetime increasing income. We want to really use this calculator to hone in on which product specifically is going to allow us to make an educated decision on which product's going to help us meet our objectives and needs for retirement. So you'll notice what this software is doing is using the hypothetical calculations with that 200% multiplier on the income benefit. And then what it's doing is it's taking a look at the associated index strategy that's going to give us the highest growth opportunity moving forward. And then it's testing it over the last 10 years, which in this case, it's showing us an average rate of return of 5.43% over the last 10. And then it's taking that performance and using the provisions of the rider contract, which has that 200% multiplier, and it's showing us at age 70. You'll notice this orange value on the right-hand side of the screen shows a hypothetical value of $10,105 starting at age 70. You'll notice also the green value just above that is showing the guaranteed value of that 1% growth rate in that roll-up benefit base. Assuming there's been no index growth whatsoever, you still have a guarantee of a 1% growth rate on the benefit base if there was no index growth. But what we're really looking at is the potential for increasing income. And in this particular exercise, it's showing us that based on the initial $100,000 investment and based on the hypothetical back test of 5.43% annualized return, factored in with the 200% multiplier to the income benefit base, the hypothetical income starting at age 70 in contract year 11 would be $10,105. So if we were to kick this out let's say to age 75, because the product has a 15-year roll-up period, we're now seeing the hypothetical income for increasing income move up to $15,729. So very, very valuable tool here, and it's one of the value adds that we bring to the table for prospective clients looking to work with us. So if you'd like to work with me directly and go through a similar exercise for this product or any other product that you've been thinking about purchasing or have been presented by another advisor or agent, you can visit our website to work with me directly. And right there at annuityassociation.com, click on the green button located on the main page to request your free report. And in that opt-in form, answer yes to the question on whether or not you'd like to be contacted by an advisor, and I will reach out to you in a timely fashion. It would be very thankful and grateful for the opportunity to work with you. So one last exercise before we wrap up is we will take a look at a sample illustration so that you can see the logistics or mechanics of this annuity and how it would look in a formal illustration. So again, we're going to use the same example, 60-year-old male, $100,000 investment located in the state of Florida. We do work with all 50 states, but in this example, we're going to just select Florida. And then we're going to select the annuity that we're looking at. Let's look at the Prime Path Pro 10. And then we're going to choose the highest growth opportunity for the index strategies using that back-tested performance. And we are going to choose the increasing lifetime payment percentages. And we're going to turn income on at age 75. So we can take advantage of that 15-year roll-up period. And we're going to download the report. See how it looks. Maybe it'll look a little better than this. Let's see. Okay, I'm going to use the actual software because it's a little larger. So here on the right-hand side, you see the guaranteed values of the contract. That's assuming there's been no interest growth for the underlying index strategy that we elected. So in theory, the chances of that happening are very slim to none, but they do have to show the guaranteed values, which is a guaranteed rate of 0. So that's the principal protection. But remember that you do have the guaranteed income base benefit growing at 1% a year. And then you'll notice that at age 75, the guaranteed income amount would be $5,689 a year based on that $100,000 investment, assuming there's never been any index growth over that 15-year period. Not going to spend too much more time there because the chances of that happening are slim to none, but do want to cover it so you can see how that works. Now, here are the hypothetical values based on current rates in the contract. And you see the $100,000 initially going in at age 60 in contract year 1. And then you'll notice the account value, which is reflecting that $100,000 investment. And then you have the income base showing the $101,000 for the first year 1% growth. Because of this being a 2-year point-to-point strategy that we allocated our monies to, we won't see the interest credit until the end of that second year. So you'll notice in contract year 2, the index performed well, the index strategy performed well, and we received a credit of 19.58% to our account value, as well as that translating over to our income base, growing it to 135% using that 200% multiplier. So you'll see that continue on. We'll see the interest credit come in every 2 years, assuming that there was growth. And in this example, there was when we look at the last 10-year periods. And then we'll notice the account value after year 10 has grown to $155,000, and the income benefit base has grown to $229,000 and change. Interesting fact here too is that you'll notice the lifetime withdrawal column. It's showing you what that lifetime withdrawal amount would be if you were to turn on income. It's showing the guaranteed value as well as the lifetime withdrawal value based on the index crediting or increasing income. So we'll notice that when we go down to age 75, which is contract year 16, we have an income starting out at $15,729. And that is the account value reaching $186,000 before turning on income, and that income benefit base growing from $100,000 all the way up to $321,002. And then you'll notice at that particular age, the payout rate or distribution rate, or what's also referred to as a withdrawal rate, would equal 4.9%. Now that column next to the annual lifetime withdrawal amount, you'll notice it's double. That's that enhanced lifetime withdrawal for confined care needs for nursing home care or long-term care. So in this particular year, when this gentleman turned on income at $15,729, the very next year, if he had a nursing home event where he was confined for longer than 90 days and needed income for that particular cost of care, that $15,000 and change would double or multiply by 2, increasing all the way up to $31,000 and change for up to 5 years, as long as he qualifies for that benefit. So you'll notice that the income continues to increase throughout the life of this product based on this hypothetical performance, assuming the index strategies continue to perform. This is to show you the mechanics of the increasing income option and how it works with the PrimePath Pro 10 or PrimePath Pro 12. So I hope you've gotten some value out of this unbiased annuity review on the North American PrimePath Pro 10 and PrimePath Pro 12. If you found some value or think that this is something that could help you or potentially help a friend or family member, please like and share this video right here on YouTube by giving us a thumbs up. And if you'd like to work with me directly, you can visit our website at annuityassociation.com. Right there on the main page, click the green button to request your free report and answer the question. If you'd like to be contacted by an advisor, select yes, and I will reach out to you in a timely fashion to set up a time that's convenient for you so that I may help you point you in the right direction. I'd be grateful for that opportunity. So thanks so much for tuning in for another unbiased annuity review. We are thankful for your time and hope that you have a wonderful rest of your day. This is Jeremiah Conjure from Annuity Association signing off. Take care of one another. Thanks so much.